Right then, guys, today we're talking about one of the most underrated insurance products out there, which is called income protection or IP. And according to the FCA surveys, unlike your life insurance that's about 35% of us have here in the UK, IP is only bought by about 6%. That's what I've said, that it's a little bit underrated right now. And in essence, it's an insurance product that will cover your net income if you are off sick for a long period of a time. Sounds simple, is it? Well, same like with any other insurance products out there, this one would also have its own T's and C's, and that's really what today's video is about. So first of all, let's make it crystal clear. This policy will only cover your income if you are off sick. If you've been made redundant, became unemployed, became pregnant, or anything else, then there will be no payouts. The payment is only provided if you are off sick. And I guess at that point, many people will say, well, why the heck I even need this policy? Because I've got my sick pay from my work. Well, first of all, not all of us have a luxury of having a sick pay provided through work. But even if it is, if you will check your employment contract, most likely it will be written in there that you get a full or a partial payout for a specific period of time. It can be a month or 2 months or 6 months or even 12 months with some employers. Hello, NHS workers. But have you ever wondered what's going to happen after that? The answer is simple. You will be moved to a statutory sick pay, which is a whopping £116.72 per week. And let's be honest, if you're making 2, 3, 4 grand a month and you've got high bills to pay or rent to pay, jumping from that to £116 a week can be very, very, very financially painful, especially if you don't have any savings and you need to get through the credit cards, loans, and all the other bad stuff to survive. And this is the exact reason why the insurers has introduced this product. When I say introduce, I mean this product was out there from the Industrial Revolution in the 18th century, but at the time it was backed up by friendly societies. When have you last heard about friendly societies? That's it, they're all gone, are they? But the interest in that product remains strong. And by about late 90s, early 2000s, IP has evolved into the product that we see on the market today. So then, the policy will cover a larger chunk of your net income, i.e. the money that you get on your bank account after taxes. Because like all of the other protection insurance products out there, the payouts on these policies are also tax-free. And when I say the larger chunk, I mean vast majority of the providers will cover up to 65 or 70% of your net income. And the two major factors that affects the price of this product is the deferred period and the cover amount. I mean, cover amount is self-explanatory. The higher your salary, the more money the insurance will have to pay, and therefore it's going to be more expensive. The deferred period is the time period after which the insurer starts to pay. Of course, the shorter the deferred period, the more expensive your policy will be. And when you're choosing the deferred period, think about two things. First one is, what is the sick pay provided through your employer? If it's a month or so, then obviously your deferred period should start after that. Secondly, if you have some savings that you can hypothetically use for that matter, and by doing so extend the deferred period, this will be the way for you to save quite a bit of money on this policy. Finally, the basis of the cover also plays a big part. You can take the policy that will last for a year or so, and then after that it will lapse, or you can take the policy that will last till your retirement age. And look, the severity of the conditions can be different. And if somebody had a stroke and they're paralyzed for the rest of their life, having an IP policy that will only cover 1 year of their income might not be the best idea. But as you can imagine, having a policy that will cover your income up until retirement will be quite a bit more expensive than the policy that will cover your income for a year. When I say quite a bit more expensive, I mean, in certain scenarios, it can be 2, 3, or even 4 times more expensive than having a policy for 1 year. So yeah, think twice about it. There are also a few drawbacks with these policies. And the first and the biggest drawback in my eyes is the fact that the pre-existing conditions, i.e. the conditions that you had before you took the policy, will most likely be excluded. So if you already had heart attack, cancer, stroke, and war and peace of all of the other different conditions, then perhaps IP is not for you, because it's not really going to be worth the paper it's printed on. I mean, nothing of course will stop you to buy these policies, but all of the conditions that you had in the past, including related conditions, will not be covered. So yeah, think twice about it. Second drawback is the fact that these policies will have exclusions. Some of them are fairly obvious, like self-harm, but the others can be a little bit more complicated. The third one is related to self-employed people. You can, of course, take the IP if you are self-employed, and obviously because you don't have a sick pay, I would strongly suggest to having a shorter deferred period. But bear it in mind that at the point of claim, the insurance company will request a copy of SA302 or any other documents that basically will prove your earnings. And if you are one of these, plumbers or electricians who's making 2, 3, 4 grand a month, but half of that taking cash in hand and only declaring half of it as an official earnings, bearing in mind that you're not going to be able to get a cover for the amount of money you want, the insurer will only cover what you're officially declaring. And the final point really is the cost of that policy, because it can be quite expensive, especially if you have a very short deferred period. Cover will be till your retirement and there is a big sum assurance that the insurer will have to cover. Do I like IP? I think it's definitely worth considering this product because end of the day, none of us know what's going to be tomorrow. And if you are off sick for a long period of time, at least there will be a regular cash coming in into your bank account to cover your bills and day-to-day living. Cash is key, especially with the big illnesses. So yes, I definitely think that it's worth considering this policy, but definitely speak with a knowledgeable broker who can evaluate your circumstances and give you the unbiased opinion on whether you even need this policy and what's going to be the best option for you. That's all that I wanted to say for today. So yes, like, subscribe, and I will see you on the next one.